to Mithun Aswath, who's the managing partner at Kivah Advisors, joining in now. Mithun, you've been positive on the auto space. The auto index has hit a fresh 52-week high today. How do you play this? What are the themes that you would play in the auto space itself? Would it be two-wheelers? Would it be tires? Would it be, tractor makers, CVs?
Yeah, good afternoon, Mangalam. I think the auto space is actually benefiting from a couple of things. You've had maybe the last 2-3 years where the commodity costs also hurt them, as well as the whole demand was not there for the auto sector. One thing led to another, the semiconductor issue, plus COVID. Now we're coming out of that, and you're seeing some of these issues kind of dissipate. We've also seen the cost of vehicles also move up, primarily because of the regulatory reasons, as well as insurance costs going up. As we go into the next 12 to 24 months, we think the increase or the inflation in the automobile prices will reduce, and the incomes which have increased will catch up. So the affordability and demand will improve, and the supply, because of the semiconductor issues, will also come through.
Mithun, sticking with stocks, one of the recent investment ideas that you're recommending is Grasim. Can you tell us the reason why? Because in our understanding, prices of VSF as well as caustic soda have come down, which means margins could be under pressure in the near term.
Yeah, good afternoon, Rima. Our whole thesis on in the markets last couple of months has been moving away from commodity producers to commodity users. The beneficiaries have been auto, building materials. And we think Grasim is a perfect bet on the whole building material side. It is the holding company of the largest cement company, Ultratech. And the company is also embarking on a large investment in the paint sector. And they're investing close to about 10,000 crores to get about a 1.3 billion liter capacity, which would make them a comfortable second in terms of size compared to the 1.7 billion liter capacity that Asian Paints has. We don't think the current valuations takes into cognizance the kind of value that can be created within Grasim, because currently Grasim only has core businesses of VSF and chlor-alkali businesses, which are small, and most of the company's valuation is attributed to its holdings in Ultratech as well as Aditya Birla Capital. We actually see even Ultratech itself expanding capacity quite aggressively and adding value to Grasim. But I think the icing on the cake is when the paint business actually gets discounted. It's going to take a couple of quarters, more than a couple of quarters actually. By the fourth quarter of FY24 is when the paints business will actually get operational. But we start, I think over the next few quarters, the market will start looking to give it some sort of valuation. And we do think, Grasim is well placed to take advantage of, Ultratech's already vast network, and they could piggyback on that for the paints business.
Okay, all right, Mithun. So Grasim, that's something that you like. But Mithun, besides sectors, do you think the markets are running ahead of ourselves right now? The earnings could see some bit of pullback. Yes, input costs have cooled off. First quarter wasn't so bad. Second quarter is likely to be softish in terms of earnings. But, the way ahead, there is a bit of a risk to that earnings growth we were talking about, 15 to 20% for the next couple of years. The Fed is going to go ahead and hike rates by 75 basis points as well. So do you think we're running ahead of ourselves? The market is topping out, or do you believe there is still a long runway ahead?
Afternoon, Nigel. I think you're right. Obviously valuations are not cheap right now. I think what has changed since maybe we spoke a couple of months ago is that the US bond yields have now come off. They were pricing in several rounds of rate hikes. Now the market seems to be in a camp where potentially we may have another couple of rate hikes, and beyond that, they may actually looking at rate cuts sometime in 2023. So the market is now trying to discount FY23 and look ahead. even domestically, I think FY23 may be a year where the commodity users will do well, but then the large contributors to the earnings growth, the commodities which were there last year, will see deceleration. So we may actually see only 10 or 12% earnings growth in FY23, but I think the market will start looking at FY24 more optimistically, and that's why we are seeing this sort of a rally. Number two, you saw FIs actually take out money from India, large amounts, and over the last 4 to 6 weeks, we've seen flows coming back, and it's actually the domestic investors who have stayed on the sidelines. So it's an interesting time for the market. Obviously, valuations are not terribly cheap, but I think any correction pullback of a reasonable 4-5% gives us that upside for FY24, which gives us the upside about 10-15% based on the earnings growth itself. And that could take markets closer to that 20,000 level, maybe over the next 12 months.
You on the point about earnings cuts, just last week, Mahesh Nandarkar of Jefferies had said that analysts tend to delay cutting earnings, and they usually do it towards Q2 and Q3. They avoid, making very aggressive earnings cut in Q1 because they want to see how the year is likely to play out. So he said that if you keep that behavior in mind, there is a possibility that we will see earnings downgrades coming through in Q2 and Q3, because that's when usually analysts tend to bring down their EPS forecast for the year. Mithun, so you told us about two investment ideas that you like. One of them, of course, is auto, and the other one is building materials. And in that, we're also classifying Grasim. What else do you like? Is there, any other trade that you would recommend, advise?
Yeah, I think there are several bottom-up ideas as well in the auto ancillary space, which look interesting after the recent correction. There is one company that we actually hold in our portfolios, a company called Igarashi Motors. They have gone through some sort of turbulence over the last couple of quarters because of the semiconductor issue. But in their recent AGM, they were quite positive on the whole domestic supply of motors to the consumer durable sector, where they're seeing a substantive sort of growth that they expect in the current year and the subsequent year, and also a rebound in the whole automobile side as well. So this is a company where the management on record is talking about revenues crossing 1,000 crores in the next 2 to 3 years, as well as profitability improving as commodities come down. So this is one of the interesting plays. It has tested our patience, but hopefully over the next 6 to 12 months, things should improve for this company.
Said it, Mithun, it's tested patience, a strong promoter entity, those DC motors they're talking about. The longer term still looks good, but I think in the last 1 year or so, the stock has seen a fair bit of correction. But as you said, the tailwinds are in place. Now it's all set to fire. Let's see how that plays out. Before we let you go, Mithun, what's your take on the IT space? The street is divided out there as well. Some believe it's corrected enough. Some say that, hey, it's not corrected as much as anticipated. And still there could be a risk to the earnings growth. Your take on the space?
Yeah, I think, Nigel, from a sector which was kind of overowned and a favorite, it has got derated primarily because of concerns of if there's a potential slowdown or a recession in the US or Europe, that the growth will come down. Having said that, if the demand also comes down a little bit and wage costs kind of neutralize and don't increase, the margins could stabilize from here. And if companies can grow at 10-15%, these could compound in a similar fashion from the current levels. So we've actually been buyers of large cap tech in the recent correction. We do think they do offer reasonable value. Select pockets, even in the mid cap, where earnings growth is expected at 20-25% and valuations at about 18-20 times, do also offer opportunities. So over the medium term, I think it does still present opportunity. Though over the next couple of quarters, there can be hiccups because of what's happening on the global side.
Mithun, thank you very much for joining in.